You've been there before. We all have. You wait and wait and wait for a breakout. Then you get the break, but price reverses. It was just a fake out. Or you'll see price break out, but think, it's too late to join. I shouldn't chase. I'm going to be responsible. But then price takes off into a beautiful trending breakout without you. Then you'd be like, not anymore, because in this video, I'm going to show you the exact way that I trade breakouts for income that has helped retire me from my day job. So what is a breakout? Prices in the market don't just go up and down, they also consolidate. And whenever we have consolidation, we can look for a break of that consolidation pattern at support and resistance. This is the same thing that's happening when we're seeing a TTM squeeze or something like that, where pressure is building up in the market and getting ready for an opportunity that could potentially explode. So squeezes and consolidations tend to happen at key levels in the market. When price breaks one of these key levels of support and resistance, which can be identified as a pattern with a price level or trend line, this is a breakout. When price breaks out of a consolidation, it's usually a relatively big move and one that I want to capture with a trade. And watching price action at key levels and structure is really the basis for all of my day trades. So when I say that I'm watching for price action at key levels and structure, here's exactly what I'm doing. And this is the same classic strategy used by traders since before there were even charts available to all of us online. So here's an example of a chart with some consolidation. It's clearly staying within some clearly defined boundaries. Both horizontal levels and diagonal trend lines both work really well for breakouts. My favorite places to find key levels is on the higher time frame charts, but we can find them on the lower time frame charts as well. I subscribe to quant levels for intraday levels, specifically the magic levels and the fire lines, which you can learn more about in some videos that I'll link. They are super reliable for finding the areas in price where breakouts are most likely to happen. As a general rule, higher time frame structures are more powerful and reliable than lower time frames. And you can find your patterns on higher time frame charts, then watch the lower time frames for your actual entries. An hourly or daily level can be real magic on your 3-minute chart, trust me. Any place we see price consolidate and make multiple touches, we have a potential level to play. There's some one or ones looking to deal at that price with a large enough appetite to satisfy the market so far. Then we can watch for price action patterns at these levels. So we're making systematic technical entries with a trading plan and strategy. So when I say pattern, I don't mean these. You know what this reminds me of? What is it? Anthropomorphism, where people attribute non-human traits like faces, emotions, intentions to non-human entities like chart patterns. We start to see happy little patterns and sad patterns and react accordingly with emotions. Bleh. When it comes to actually finding them on the charts, it's like looking for, animals in the clouds, which, come to think of it, is called something else. But it's all this like, do you see it or not silliness? And maybe it's the ADHD talking, but I find that to be a distraction that I can't take tradable action on. But what's clear to me is if we break a clear price level or structure and candles either fit a list of rules or don't. We don't need all of these happy little characters to trade. This isn't coloring book school. We're trading grown-up money. The good news is we aren't gatekeeping here, so we can understand what's going on at these levels. If you want to keep it simple, and you do, the most basic support and resistance plus the price action entry strategy that I'm about to show you is really all you need. When we have a major level, it's an area where major players, the whales, are doing their business. They can't just throw out a quick market or limit order for their massive position and expect it to be filled at that price level. That order will move the market. So instead, a human in charge will turn on a buy or sell program at that level area to get their transaction moved over both time and over a price range. So it's kind of like we're trading in 2D and they're trading in 3D, but hey, it's easier for us. So eventually that order will get filled and price can break through until the next whale comes along up for air on another level and so on. But on the flip side, these levels can also be used as liquidity for larger players looking to reverse or hop out of a position and head after a target in another direction, which will really just eat up your stop and spit it out. So how can we tell the difference? We have our support and resistance and key levels and trend lines. Now we just add price action, which is really just how price behaves and not all of these crayon drawings. If we get in as soon as price breaks out all willy-nilly, we have a pretty decent chance of getting caught up in a false breakout or some chop. A lot of folks will tell you it's like 80% of the time. I've seen as low as 60%, but whatever. It's a strong majority of the time. Price will break your support or resistance level before reversing. So just having that break isn't a reliable enough indicator of trend breaking out. One clue that we can use is the type of candle. So we're looking for a confident, relatively large momentum candle rather than some little indecisive little dojis or whatever stair-stepping around the level. It may also be a series of more medium-sized candles that form a larger candle on a higher time frame, especially if you're trolling a super low intraday time frame. But we're looking for a big showy Gaston candle and not a humble little Quasimodo candle. So a strong, confident candle should also have some strong volume with it. Gaston travels with an entourage, right? Quasimodo, not so much. Quasimodo might be able to put a dent into a price action wall, but Gaston with his hype crew can really get the mob going. So when price breaks a level, there are basically three things that could come next. Price could break and go, where we have picture Gaston with his hype squad plus the mob going full ape. It's gonna break and just get out of here. The second option is it could break and then pull back and retest and then go, which is where Gaston and the hype squad break through, but they decide to come back and get the mob. And then we could also have the third scenario, which is the false breakout, where price is going to break through that level and then immediately either come back into chop or do a full reversal. So that's where we'd have Quasimodo breaking through, but going back home to Esmeralda at the end of the day. A lot of traders like to play pullbacks, which can be a really great strategy. We should be cautious of buying the highs or selling the lows for a breakout, but we won't always get that chance. If it breaks and goes full mob mode without us, then we lose an opportunity. Price is less likely to break and give us the pullback, so we need an entry strategy to capture these breakouts. Price won't always break and give us a pretty little mob gathering pullback. So how can we be sure, or at least more sure, since trading is dealing in probabilities, that price is really breaking out without the drama? The most basic price action setup is buying the breakout candle. We place a buy stop at the high of the momentum candle. Some people prefer the close, but I like the high. Here, we can have a lot more confidence that we're buying a breakout. Personally, I like to give it a tiny bit of space, like a couple of ticks on the ES futures. The real edge is the risk to reward, because we're looking for a big move, but also a tight stop. So the stop goes opposite the entry on the opposite side of the breakout candle. This way, if price continues breaking out, we make money. And if price retests before breaking out, we still make money. If the breakout fails, our funds are never at risk and we can move on looking for the next potential setup pretty relatively quickly. It is risky buying highs or selling lows, but when we can limit the risk while setting up to capture the reward, the math is on our side. And this is the point where a breakout is most likely to form. To make sure that the risk is reasonable and defined and limited, I like to avoid setups that have a lot of large wicks and are just kind of generally messy and harder to interpret. And those where the stop loss is too wide for the risk that my account can take. So if I'm trading one ES and my max loss is $500, but the stop would be 15 points, it's a no-go, which is fine because it's likely that I'll be able to find another setup at a different time or on a different asset or MES. I like to target something structural like a recent significant high or low, or a major level of support and resistance. Before entering the trade, I can see where my entry and stop loss are, so I can see if my target leaves enough meat on the bone to justify putting on the trade. I like to book the profits, or at least move my stop into profit once the breakout starts running. I like to book most of my profits, meaning at least half, probably leaning more towards 3/4, and then move my stop and see if we can get extended targets, because one of the main attractions to breakout trades is their potential to make a really strong, significant move. And there's nothing wrong with managing a single lot and booking profits at a first target, but we've got to walk before we run in trading. But once you have a larger account with room for a larger position, that's when you can start to trail your breakout trades and try to maximize your profits even more. Okay, here's an example where we get a break that fails, so we never would have gotten in. After the fail, though, price breaks out to the other direction, giving us a brand new entry. We can enter on the momentum candle and off we go. Sometimes after an initial break, price will come down and retest or fail the level. We don't want to be sitting in the trade while 2 out of those 3 options are still firmly on the table. So keeping our entry above the retest or failure keeps us out of taking heat or taking a stop loss unnecessarily. When we do get the retest, we have the same entry and I can put my stop just under the retest candle. This will look familiar to Firelines traders. It is indeed the BHG, or break, hold, and go. It's a less aggressive version of this breakout entry. I'll link to a longer video, but here's the quick version. For a BHG, we watch for a level to break. That's when we're ready. Then we get a candle that goes against the breakout. That's fine. We just want to see that the next candles hold the price level. If they don't, we're at ease until the next setup. But if we do get the hold, that's aim. Then once price breaches the break candle, that's the go or fire. Stop loss goes below the hold or breakout level and targeting the fire line or anything else that is reasonable and obvious. In a lot of breakouts, we see a pause on lower time frames where price will do a little mini consolidation. And that's where we're looking for a fibwit or a first bar with trend to use as our momentum candle. And the same rules apply. So we can drop the hieroglyphics. You don't need an inverted caterpillar unicorn pattern or to read any tea leaves. You just need a level formed by consolidation and some simple understanding of price action. There will be failures and stopouts, but with clearly defined risk and probabilities in your favor, you have a trading system and you can make a plan to trade it accordingly. If you found this video helpful, do me a favor and make sure to hit the like and subscribe buttons and watch more trading strategy videos. If you're curious about the indicators on my charts, check out the Bull Barbie's toy box playlist, and I'll link those below as well. All right, love you. Bye.